Good evening. Happy Sunday evening. How is everybody doing out there? Let's see what's going on with the market. Bitcoin was freaking crashing last time I looked at it. Or not really crashing, but sorry, I didn't mean to. It doesn't look Bitcoin doesn't look as bad as salty. Just to be honest about it, nothing looks as bad as salty. Um, but that doesn't look great. That's not what I wanted to see. That is not. Does anyone know if there's news? Well, I guess right here. Um, it says strategy announced Bitcoin purchases. I mean, uh, Bitcoin's price dynamics shifted as the CME, the Mercantile Exchange, speculated that speculators cut bearish positions. The CFTC reported non-commercial futures traders reduced net shorts, indicating more of a move towards bullish sentiment. Okay, all right, that's good. Analyst somebody noted Bitcoin's Sharpe ratio is a negative 38, indicating it's a low risk accumulation zone. Yeah, it's a deep value right now, considering it's down 50% from its all time highs. Yeah, I would agree with it there. And then who said this? Bitcoin's price may reach 122,000. Do you think it could be there by tomorrow? Or can it be there by Friday? I'd be fine with Friday. Let's just get this thing going the right direction, right? All right, let's look and see what some other stuff is trading at. Check out some S&P futures, and they're also soft, down from, and we're down 45 points right now. Now, we're still trading well with inside the previous week's range. It doesn't look like it's breaking down the way breaking down, breaking out of previous ranges like Bitcoin was, but doesn't look great. Let's look at the Russell. Is the Russell up? No, the Russell's down 26 points, or the Russell's down more than 1%. Oh gosh. Oh gosh. Okay, well, let's check out the old NASDAQ. I don't really get worried until something moves more than 1%, but once you're down 1%, it's anyway. Lots of times it goes down 1% or two overnight, and then the morning it gaps down and people buy it and everything's fine by the next afternoon. So, all right. So NASDAQ is down 214 handles, and that's about 85 basis points, 0.8%. Let's look at, I would figure silver would be strong because my friend Brad just told me it was strong. Yeah, I was talking with Brad just about 30 minutes ago, and we were talking about silver and gold futures. And of course they're up. Of course they're up with the way things are going on in the world right now. Here's some gold. No, that's not gold futures. Yep, gold up 2%. Good job. Oh yeah, K gold and K silver are going to be high tomorrow, but this still has all the marks of overheads, all the hallmarks of overhead supply. It'd be interesting to see if we can get through that. Well, we got Charles in the house, and we got Dividend Degenerate. Yeah, I know it. Well, it's 9:07 probably if you're on the East Coast. Hey, Charles, tech stuck sideways, non-tech reaching, yeah, huge valuations. I mean, heck, Caterpillar, the Dow Jones Industrials just going insane. Absolutely insane. I mean, anything that's in, I mean, like the XLI is what I should have punched in. That's the whole group. But yeah, this is insane. This looks like a chart of Nvidia, but it's it's a chart of Caterpillar. Boy, look at this giant gap there. That's the market sending you a message to me. Especially because it never did get closed, and I mean, boy, there's more people bought it. I mean, there's definitely. I think there's still some buyers down there, and I don't know if they're still down there, but they were definitely there. They were definitely there a while back. Anyway, that's Caterpillar. Let's look at the XLI. This is the entire index. Yeah, so it's the same thing. This is the State Street Industrial Select Spider ETF. Well, speaking of all this stuff, we have, well, let's see what Charles says first. Around 1% drops in non-market hours in futures tells me plenty of sellers in this market. Yeah, not a great sign. And to me, the chart pattern. Let's pull up this chart pattern. I mean, I didn't read. I think I skimmed the Wyckoff book really quick, or I probably read it before, but you know, he's big into distribution tops, and I believe that's Wyckoff. Anyway, to me, this looks kind of like a distribution top. I mean, so far there's been, you know, there's supply underneath, and it's lasted so far that, I mean, you just wonder next time if there'll still be supply there, or they'll pull the rug, and then, you know, the banks will let it slide down here to 160 before they start buying again, or wherever, let it slide further. Who knows? Right now we're doing great. I mean, you know, if you look at it on a daily chart, I mean, even if you figure out we're going to be open down 1%, if open was right now, it'd be right here. I mean, you know, that's not the end of the world, but we'll see. We will see what happens. All right. So yeah, let's talk. I'm going to take that off the screen. Let's talk daily factor, because I think I have a good show planned out tonight. I'm always looking for my max factor shows. I'm always looking for interesting variations for the daily factor. I want to make sure we show everyone's funds at some point or the other. If we just focus on the top 20, you're going to see the same funds every week. But we have too many of them to focus on every one of them. So I'm coming up with schemes to make this more interesting for you guys. So what I thought would be fun to do tonight would be to focus on numbers 21 through 40, maybe the ones that just missed it. And really, I pulled up the whole database. We can look at even the ones down to 50 and 60. There's some darn good funds at 50 and 60. Triple QI, I think, is down there. Just has the NASDAQ's off a little bit, you know, so Triple QI hasn't been performing as much as IWMI, but no one would doubt it's not, you know, it's not a good fund. Also, Round Hill, I had a comment on my top 20 video. Somebody said, where's Round Hill? And it's a fair question, and we'll see where Round Hill is. We'll see where the highest Round Hill one that made the list, and we'll see what they need to do to get back on the list. Some of the Round Hill stuff, of course, has that 20% leverage. Anything W series has 20% leverage, and a bunch of those are based on stock. And of course, so that and WPay has been down lately. But XDTE, QDTE, Round Hill has some excellent funds that I'm sure will be are going to be highly ranked somewhere in here. It's just when you're following nearly 300 stocks and you just show the top 20, that's the top like 7% or something. So, you know, there's a lot of good stocks that may not fit in the top, you know, 7%, you know, and the top 20%, you have to be the best one out of there. If you're in the top 20%, it means there's 4 stocks worse than you for every 1 stock that's as good as you. I mean, so most of the list is, and I'm positive Round Hill and Dios and these other ones will fit into that one, but it just depends. It's a market by market situation. There's a lot of good funds that didn't make the top 20. And then there's some bad funds that did make the top 20, because my list is also, one of the factors is momentum. And so something like Murni, as bad as it's been of an investment over the long term, has actually, for trading, has been a great trade this quarter. I mean, so anyway, all right. So let's get this show on the road here. How about that? So what I'm going to do is I'm going to take myself out of the shot, and I'm going to show you guys some stuff. Now, I have something else to show you first. Okay. All right, so this is my little graphic on the daily factor. I'm trying to get some better explainers going on, but I think this graphic is a good way to visualize it. I just gave AI my data set and told them to make some graphics showing the correlation between the short-term max factor, the stable DEX, which is the stability, and total return. And what they came up with is a sweet spot, and it's this week is like 18%. But basically, it's these funds that pay a high enough yield to actually get a decent total return, but not such a high yield that they kill the future upside of the NAV. So anyway, right down here, you know, it looks like BlackRock. BlackRock's leading the way just out of these three they mentioned, but Curve and JP Morgan also have some good funds with some strong short-term max factor. The you know, Round Hill and Yield Max take a little bit more risk, and if you look at their average max factor, it was actually negative. The three highest company-wide max factors. So I think you have to have 4 funds or more to be in this list. There's actually BlackRock, Curve, and JP Morgan. Everyone knows those are good. Short-term max factor actually shows a strong positive correlation with 1-year total returns, which is good. High yields are strongly linked to quarterly NAV decay, indicating dividends often eat principal. Yes, correct. The stability versus momentum trade-off, and that's the whole idea of the max factor. So anyway, let's get into it. Let's get into the second 20. This is called Second Chance Sunday. I couldn't think of a good name for it. That's what it is, Second Chance Sunday. Oh my gosh. I told them just missed the list, or missed it by that much is what I was trying to think of something like missed it by that much, or just missed, or something like that. But yeah, Second Chance Sunday from now on. And I'll probably go 20 through 50. I just went through 40, but anyway, we can look at any fund you want. If well, you know, after this little deal's over, we'll look at anything you want. So let's go by yield. The highest one is USOI, of course. Now, this is not in order. We're going to actually, I'm not going to do a reveal, but we're just going to do it like a daily factor show. We're going to look at the contestants. So USOI actually has flat NAV this quarter, and, you know, it's paying a decent yield. So, I mean, now it's stable dex is only a 51, not super stable. Let me try to zoom this in a little bit. All right, that's a little zoomed in. All right. IWMW. Let me make sure that I can see you guys. You guys can see me. Yeah. All right, Charles. I'm going to get to your comments. I agreed with what you were saying, but we can talk about that in a little bit. All right. IWMW. This thing's gone this quarter from 38 bucks to 39.5, basically, and paying a 20% yield. So obviously this one's doing well. This is from ProShares. Now, I'll tell you, it's not doing as well as IWMI by Neos, because if you saw my top 20 show, IWMI was doing better than this one, and also RDTY is doing better than either of them. At least it ranked higher on the daily factor, but it's real close. RDTY and IWMI were right neck and neck. Anyway, SLJY is he's another contestant, I guess, paying a 14% yield. Boy, this NAV's been incredible. As you guys know, it's up 10 bucks, which is about 30-40%. YYY is a fund of funds, a fund of closed-end funds. So this thing is NAV stable. It's actually up like 50 cents. So we'll take it. That's about a 5% increase in NAV. Combine that with the 20% yield. And you also look over here at the stable dex, which is a 179. This is the YYY is our most stable so far, but it's that fund of closed-end funds. And so that doesn't surprise me. Next, we have another contestant from Neos. We have IAUI. Now, this is the Neos fund that sells covered calls on the I forget the underline's name. It has something with AU in it. I don't know if it's IAU, but anyway, they sell covered calls on gold somehow. And I don't think they use GLD. I think they use the other index. But in any event, this has paid about a $5 yield over the past 12 months. And the NAV's gone from 54 to 61, 54.5 to 61, basically. So you have an increase in NAV. Your NAV's increased by about $5, and you have about $5 worth of dividends in your pocket over the past year. So that's been a good one. We have Stretch and Stride. We can talk about them together. They're preferred stocks from Strategy. They're both paying around 11%. Stretch's NAV has gone from 92 to 99. Stride's NAV has gone from 66 to 76. I mean, they're both doing good. Let's look at the risk. Let's look at the stable dex. Stable dex, Stretch is about twice as stable as Stride, just mathematically, just by looking at the price action over the last quarter. So not an endorsement of either one of them or the other, and we can't predict the future. No metric can. All right, next we have RNTY. All right, so this is from YieldMax based on REITs, right? Or it's that let's just go look. Let's just go look. Why don't we? Oh, and it's a Target 12 one. So it's real estate was the word I was struggling to find. I mean, anyway, but let's see what real estate actually means. So Welltower, Prologis, Texas Pacific Land Corporation. Man, that thing's been on fire. Holy cow, that's gone from 300 to 500. My Lord, I've never even heard of that. And I'm from Texas. Digital Realty Trust. Anyway, this business has been hot lately. Partly because real estate is traditionally been an inflation hedge, or people have traditionally used it for that way. Simon Property Group. This is a good one. They own every mall in America and all the good ones. They're I believe that's what Simon does. Malls and mini storages. They're out of out of California, and the owner of the Clippers, the former owner of the Clippers, was the founder of Simon, I believe. I'd have to fact check myself, but I believe that's right. What is St. Joe Court? Anyway, all of this stuff's on fire. There's a little realty income. So anyway, lots of good REITs in there. This is paying about 8.79%. If that can help you out, maybe this one will work. All right, so the Just Missed It list. Let's get back. We have ASGI. This one needs no introduction. All the closed-end fund bros in my Discord know all about this one. NAV's gone from 24 and change or 21 and change to 24 and change. That's a nice little 14% rise in NAV. You combine it with the 0.50 on volatility, meaning it's half as volatile as the market, or it's half as stable as the market. So it's going to be on the riskier side, but this thing's has had some good NAV performance, especially over the past year. Yeah, look at that. As the Aberdeen Global Infrastructure Fund is probably profiting off some of the same types of trends that last one, that rental, I call it rental because it's hard, but it's basically real estate, the real estate fund, basically. I bet this is profiting off some of those same things. Building, construction, infrastructure, that kind of stuff. So next we have CHY. Okay, what is this one? Is this a closed-end fund? I used to know it's China. It's China-based, right? No. Oh my gosh, I should know this. This is the Calamos Convertible and High Income Fund. All right. Well, I really like Calamos. They're known for their buffer and defined outcome type stuff. Auto callables, that's kind of their jam. And this thing has strong NAV, pays about 10% actually. Yeah, that's not a bad looking fund right there. I wonder why it didn't rank higher. And maybe it's kind of risky. That's why it didn't rank higher. There's an error on the stable dex and it's a 0. So anyway, sorry about that. Okay, MDST. So in other words, depending on how stable it is, let's go look. It might be a little bit higher. We could kind of, here's a proxy for stability is the, oh no, no, they don't have it on here. Anyway, I'll fix that. I will fix that. Okay, MDST. Boy, this is a good one. This is a no, that's not it. MDST, right? Yeah. Oh, this is another one from Westwood. Okay, Westwood made the top 20 list with the WEEI, and that one is energy infrastructure. This one is called the Westwood Salient Enhanced Midstream Income ETF. So let's see what they're selling options on. And they have some Enbridge, some Williams Company, some Kinder Morgan. Williams Company is a good old Oklahoma company. They're out of Tulsa. Kinder Morgan, I believe they're out of Louisiana, I think. Anyway, One Oak, that's an Oklahoma company also. Lots of energy in Oklahoma and Texas. I grew up around it. This company, Westwood's out of Dallas. All right. So next we have Soxy. Then we have, everyone knows about Soxy. I don't need to go. Then we have RSPA. It's based on the equal weight SPY. So in theory, this should do better this should do better when Max 7 gets clobbered, because Max 7 makes up like 30 or 40% of the index. This is just equal weights everybody. So in theory, it should do better. In some type of situation where the broad market outperforms the Max 7, which is probably what we're in right now. I mean, let's see how RSPA's been doing. It's in the Invesco S&P 500 Equal Weight Income Advantage. Wow. Good looking fund. Pays 8.81%. Has 11, or we'll call that 12%, a 12% total return. So that includes dividends, it includes NAV, the whole ball of wax for the past year. So you have a fund that returned 12% total return, but yet along the way it paid 8%. So that means the NAV is going to grow 4%, basically, because that's all there is to it. And so sure enough, this isn't quite a year. For some reason, it's like a little bit short of a year. I don't know why they didn't just make it a year, but I guess we could do it. So we do it like this. So if you go, they make it like way shorter of a year. So, but you can see here for the past year, it's basically flat, but it's paid the 8.81%. And so, all right, let's look at the next one on the list. ICAP. Now, ICAP's interesting. I just started hearing about this, or I just put it on I've heard about it for a while. I just put it on the Factor recently. I forget who was talking about it in Discord, but I mean, this is a infrastructure capital equity income. It sounds kind of like a closed-end fund. It sounds like that Aberdeen, or there's some infrastructure-based closed-end funds, but this is an actual ETF. So let's look at their top holdings. This is infrastructure capital equity income. So let's see what that means. McDonald's, Amazon. Boy, McDonald's doing all right, but Amazon is ugly. I mean, anyway, I didn't realize it looked that ugly. Global Net Lease, Citizens Financial, Toll Brothers, Marvell Technology. That's weird for a chip stock to be down. I mean, a lot of chip stocks are doing well, or semiconductors, but not Marvell. Anyway, Lennar Corporation, the home builder, NextEra Energy looks great. Anyway, that has been doing a fine job lately, so good enough to make the second 20. JEPI is kind of having its moment in the sun. I saw a video on it today, and look at this. I'll just do the same thing this guy did. So JEPI. Let's look at JEPI and SPY-I since inception for SPY-I. Okay, SPY-I is a lot better, right? I mean, everyone knows it. Everyone knows SPY-I is better. I mean, it's everybody knows that. It's NEOS, it's better, right? But they have different strategies. SPY-I has a great strategy. They do basically the Tasty Trade strategy, sell S&P, SPX options. and they go out 6 weeks and they cover it 2 weeks, kind of the tasty trade strategy. Well, nothing wrong with that. Now, JEPI does something different because they also sell options, SPX options, or they may use swaps, but in essence, they're selling options. But they're actually, though, they don't just buy the whole index. They choose 100, 150 stocks out of the S&P, and they don't even have to be out of the S&P, but they choose more value-oriented stocks from what I understand. And lately, because of their bent on value, they're actually doing better. If you look like over a shorter time frame, just like everyone knows SCHD sucks, right? Everybody knows that SCHD sucks. Well, not lately, it doesn't. You know, yeah. Look at JEPI just leaving SPY in its dust. Anyway, but it's just a difference in the way they manage the funds. There's different funds for different times in the market. There's lots of times when you would have totally rather had SPY when the market's melting straight up. You know, the value plays like JEPI's doing aren't quite as valuable. But when the market is rotating or, you know, going through changes in leadership, something like JEPI might shine. But I thought that was interesting. All right. So, I mean, there's no fund that really sucks. I mean, other than FEAT, FEAT, but there's some fund that, but funds are built for different environments. You know, some funds are built for more bullish environments. Some are built for less bullish environments. Or some strategies, I should say, which I guess is the fun. All right, so what else do we have here? We have ICAP, JEPI, but that JEPI is impressive lately, isn't it, over the past quarter? And you notice here, SPY is not on this list. You notice that? Well, SPY is like number 50. We'll get in that in a second. All right, CEFS. This is a fund-to-fund of closed-end funds. Let's look at this. But I believe it itself is an ETF. Yes, it's from Saba. And let's see what all it has in it. I think it has that ASGI in it, doesn't it? No? Okay, it has ASA, which is a gold and precious metals. That's actually a trust or a mutual fund. Then it has a little Van Eck GDX. That's a fund. And then we have a little a little ECAT. If you noticed my top 20 show, I believe BCAT hit the top 20. Anyway, and then you have some of this Virtus, NFJ, whatever it is. Whenever I start doing the bigger lists, we'll start following some more of these more obscure closed-end funds and stuff. All right, so that was CEFS. Then we have IDEVO. Somebody asked me last night why IDEVO wasn't in the top 20, and the reason is because there's better. It just doesn't quite. It's good. It doesn't quite have the metrics. It only yields 5%, and the NAV's plus 18%, which is great. But believe it or not, there's ones that have a better combination, especially when you factor in. Well, IDEVO is not very risky. It's only a 0.76 on stability. So anyway, our next one is NDIV. Oh, I know what I was going to say, but so the person that was asking me, I went and pulled up some ones in the top 20 that had better metrics, and DOGG has the same NAV or better and pays 3 times the yield or something. So I mean, and with the comparable safety factor. So IDEVO is good, but it fell out of the top 20. It'll be back. All right, NDIV is yielding 4.6. NAV's gone from 26 to 32. Let's look at this thing. That's incredible. NDIV, and this is the Amplify Energy and Natural Resources Covered Call ETF. Okay, so let's see what they're selling options on. Petro Brazil, PBR, little Eastman Chemical, Northern Oil and Gas, little whatever that is, Lindell Vassell, some kind of German something or another probably. Little Dow Chemicals. Anyway, oh, what's this one? I just noticed this Kinetic Holdings. I wonder if that's some kind of. I was wondering if it's some kind of weapons system or something, because they always talk about when a war goes kinetic and things start blowing up. But no, it looks like it's an oil and gas pipeline company. And Occidental is supposedly Occidental's interested in taking a run at, or somebody's trying to take over Western Midstream, which Occidental owns, and maybe that's affecting this one or something. Anyway, the last one is SCHD, and like I said, everybody knows. Just like everybody knows YieldMax sucks. Everybody knows SCHD sucks. And not even any reason to debate it. It sucks. It just sucks. Everybody knows that. Well, not lately. So yes, it has sucked. I mean, it has lagged other things, and it pays a low yield, so it's a double kick in the teeth. Could pay 3%, but the strategy is they buy stocks. That doesn't make any difference, and you can have the synthetic or the stock. But what they do is they actually buy dividend stocks. Dividend stocks are more stable than stocks that don't pay a dividend. They have a portfolio of them. So this strategy is paying off nowadays because it's more of a value strategy. So let's do it on a shorter time frame. And you know, I love when everyone knows something that doesn't come true. That's one of my favorite things about the channel is busting myths. I mean, there's so many things that people think about these funds that aren't true or that are half true and, you know, but nuanced. But anyway, yeah. So tell me how bad SCHD sucks now. I mean, and I was one of the ones saying it sucked. I mean, whatever, just because I don't like things that pay a low yield. But my point is, no fund really sucks. Except for feet. For most funds, there's a time and a place for that strategy. It depends. All right, so let's get this list over with. Let's see who won. So first of all, let's sort it by StableDex. StableDex is a really important feature. So as far as the most stable goes, it's YYY, JEPI, CEFS, RSPA, MDST, and ICAP, SCHD. That's a good stability list. All right, but stability is not the only thing. Like I've always said, a fund can be too stable. So let's sort it by the Quandex just to see who has the best long-term max factor. And it's ICAP, SOXY, ASGI, IDEVO. And this goes back over a past year where the max factor just looks at 3 months because it's a trading index, because it also factors in momentum. The Quandex doesn't factor in momentum as much as the short term. Anyway, but those are some good ones. I mean, I wouldn't get any argument from you guys that I wouldn't think that IDEVO, SOXY, ASGI, ICAP, SCH, well, maybe SCHD, but a lot of those have been decent investments, especially lately. So let's do the short term. So here's the second 20. Number 21, SLJY, based on silver. Then we have YYY, MDST, CHY, SOXY, JEPI coming in at number 26, RSPA, ICAP, ASGI, IDEVO, IWMW, NDIV, RNTY, CEFS, SCHD at number 35, IAUI at number 36, USOY at 37, STRD and STRC rounding it out. I don't know why those are ranked so low, but I mean, they're really risky. Some of these other ones are, the safety really plays a big part. I mean, I tried to intentionally make this metric as safe as possible, as conservative as possible. Like I always say, I run it through a filter, but I demand positive NAV return. That's the first thing. That's the first factor. But there's also, then it also goes through a volatility factor. And then of course it looks at yield, and it looks at NAV return, and looks at indirectly, it looks at total return. All right, so I got a comment. Why isn't Roundhill on the list? And there isn't a Roundhill yet. Let's go see what the highest Roundhill one is. Now that's today's top 20. I just brought that up in case we need to refer back to it or something. There's some good ones on that list too, as you guys know. But let me do this right here. Let's just download this and let's open it like this. Okay, so here's the entire list. So let's see where the highest Roundhill one is. So I didn't have a number this one, but we're just going to have to go down here to Stretch and Stride. Stretch and stride were the end of it. Okay. Number 41 is Fiat. 42 is HCal. 43 is Spin from State Street. 44 is XYLD. Remember a few weeks ago, that one was, in the top 10 of the Max Factor, but it's fallen off. It has definitely fallen off. Then there's Devo, SLVO, UTG, QYLD, YGold, GGN, GPIX, FTHI. Where the heck's Roundhill? SPY-I. But I mean, there's other good funds that are, that are also lower ranked. SPY-I is a great fund, but it's only making a 5% NAV return. Pays a 12%. Yeah, that's fine, but there's a lot of ones that pay the same yield and have 10, 15, 20% that are ahead of it. So anyway, or even better. There's some that have better yields, but WTPI, that's the Wisdom Tree. I think let's look at that really quick. I think it's a put selling fund. Oh, premium income. Okay. Now I can just, by looking at the chart, this looks super stable. I bet if we go look at the stable dex, this is like a 120 or something. I bet this is super stable. But over the past year, the total returns have been 11.5. That's respectable. Master table. Okay, let's go. I know it's small. I wonder if, let me try something here. I'm trying to do the zoom. It only zooms when I don't want it to, and there we had it zoom. Okay, so all right, what was I talking about? Okay, SPUT, TDAC, SVOL. We have some good ones down here that they're either some combination of too low of a yield or too low of NAV return considering the yield, or not stable enough, or some combination of each. All right, here's that WTPI. Let's go look at the stable dex and see if I was close. It's got to be 120, 130. I can just tell by eyeballing it. Yeah, 125 right there. So, all right, well, that's a pretty good eyeball. I do this all day. All right, so JEPQ. Now, you might say, why is JEPQ not higher? But it only made 3.7% on NAV. I mean, that's fine. But there's ones out there that are doing better. T-SPY. I mean, T-SPY is a good one. I mean, 13%. But once again, the NAV is only 2.4%. I mean, there's better ones out there. I still haven't seen a Roundhill one. Well, I can't believe XDT and QDT aren't on here. But anyway, let's keep going until we find them. MLPD, EDOG, SVOL, WIL, TDAC. TDAC is paying 15.9%, but it's been kind of mids on the NAV return, 2%. I mean, it's better than some of these. At least it doesn't have a negative NAV return like Triple QI does or something. I mean, these are definite, out of a list of 300, we're looking like the top 50 right now. I mean, so this is still in a very, very rarefied air. These are all decent funds. iGold could work out. I mean, there's nothing wrong with iGold. I think it has kind of a low stability factor. I think it's like pretty unstable. Yeah, it's only a 28. Or no, I'm sorry, it's a 32. Whatever, it's low, but that's what it is. It's 32. So it's a third as stable as the market. Little wild ride there, but anyway, SPUT. Then we have some AC2. We have some of those auto callables, and this is the highest auto callable on the list. I mean, you only get 2% NAV upside and 5% yield. I mean, it's all right. GPIQ, SBAR, GUF. Where the heck is, now I'm getting mad. I'm thinking that it's RDTE is the highest ranked Roundhill one. So let's see what's going on. And that makes sense because it's Russell. And the highest ranked NEOS fund, index fund, was Russell. The highest ranked Yieldmax index fund was Russell. So it makes sense that the first Roundhill we see is Russell. So let's just take a look at RDT. It's paid $13.67 over the past year in dividends. The price has gone from $29.99 to $30.06. I mean, that's what does that equal? It equals just about flat. It's up 0.25%. And then we have Bondi. Now, Bondi has the same NAV and pays a lot less yield. And even when you factor in that Bondi is safer, it still ranks behind RDTE because look at the difference in yield. NAV's the same, difference in yield. I mean, big difference in yield. So, but anyway, that's the highest Roundhill ranked one. So let's go look at RDTE. And let's look at it versus IWM since inception, and not a bad looking chart. I mean, it's typical of most covered call funds. It looks like on a total return basis. Hang on a second. I think there's something wrong. Oh yeah, let's go back. That's just for the past quarter. Let's go back since inception. Okay, since inception, been out a year and a half. Parent gets 30%. This thing's up 18. So, that's about 3/4 is catching, 2/3 of the upside, 3/4. Pretty typical for a covered call strategy. The price, a year and a half ago was 42. The price now is 29. But you've received $20 in dividends. So, I mean, if you had it since day one, you're up, you're up 18%, and that annualizes to 12.6 because it took you a year and a half to make that 18. But anyway, all right. So let's look at TE versus IWMI, which is the highest ranked NEOS one, and the NEOS one beats it, and since inception. They both do well. I mean, one made 18, one made 24. The NEOS just is a little better. And if we look over the past quarter, obviously the NEOS is going to be higher because it was the NEOS fund is like 8th on the whole list. But let's just kind of look over the past quarter. But so there's nothing wrong with Roundhill. This quarter, there's been better options out there. And there we have it right there, IWMI. RDTE basically on these dates I chose, their NAV was actually down a little bit, but not much. I mean, well, down about $1, and that's just a big difference when you're comparing it to a fund that over the same date was up $1.50 or $2 actually, $2.15 actually. So yeah, I think you guys could see NEOS one is better, and actually the Yieldmax one beat the NEOS one. The Yieldmax one, RDTY, beat the NEOS one, but it was they're right there together. But it was one or two spots ahead on the factor. But I mean, they're right there. I'm not going to call that, but the Yieldmax one is doing great. Look at the Yieldmax one. Just like everyone knows Yieldmax sucks, right? Everybody knows Yieldmax sucks. Stay away from Yieldmax. Well, it's a fund-to-fund thing. It depends on what fund what fund you're talking about, and what market conditions you're talking about. But lately, you've been a lot better off in RDTY than you would have been in the Roundhill version of the same thing. RDTY was able to grow its NAV where the Roundhill wasn't. So it's nothing against Roundhill. I don't use any input on, I don't give any, I designed the formula, but I don't choose what goes in the top 20 or whatever. The Roundhill ones will be back in the top 20 as soon as they start doing better. That's just kind of a little bit of weak performance. So let's go see. So CAIE, I want to check this out. And then after this, I'm going to talk about this one. Then I'll look up any fund you guys want, and we can go see where your fund is and why it didn't rank higher, or whatever, if that be something that interests you guys. Anyway, CAIE, I'm doing this for my friend Marcus. He's been all over this one since the get-go. So I'm kind of curious why this one isn't ranked higher, to tell you the truth. So let's go look at it. So it's made 13.4%. NAV's only up 5 cents. Okay, but so let's compare CAIE with the other closed-end fund. That was AC2, right? And there's AC2. So AC2 actually pays less yield, but the NAV was up 2%. And when you do the math on it, you're much better off here. Not to mention, or you have been the past quarter. Not to mention, AC2 is, gosh darn it, I should have frozen the rows at top. This one right here. AC2 is a 189 on stability, meaning it's 189% as stable as the market. Great job. Very stable. I bet you CAIE is less stable. And of course, they pay a higher yield, and generally yield is a proxy for risk, not always. So let's scan down here to CAIE. And yeah, CAIE paid about twice a little bit more than twice the yield, but had, you know, a fraction of the NAV performance, and then was a 107 on stability, which is fine. That's still more stable than the broader market, but when you throw that all into the same bucket, AC2 is the one that's doing a little better, at least the past quarter. So what do you, oh, the TLTI, that's a good yield max one, or not yield max, NEOS, TLTW, iSpy. There's some good ones down here. I mean, XPay, I don't have any problem with XPay, but you know, it's yielding 20% just like it's supposed to. NAV's down a little bit. Now, the problem is with that, the one problem with that is they sell stock. So, you know, if the market's weak, I mean, anyway, it's just a different way. It's a different way of gaining income. In lots of instances, in some instances, the just selling stock plan works better, and some it doesn't. All right, so I'm going to zoom back out, and I'm going to talk to you guys. What do you guys want to talk about? There's 13 of you guys here, and I certainly appreciate it. All right, let's see what Charles has to allow. Yes, tech stuck sideways, the 1% drops. We've already seen that. Bitcoin at 60 looks important visually, yeah. So, and I'm thinking it hit 130, and I'm just a real big picture guy, and a Fibonacci retracement is like 68%, right? 65. So if you take 65% of 130, isn't it 60,000? And that's for the whole time that Bitcoin's been out. So I would definitely say that's an important number. No guarantee that it holds. I mean, but I saw somebody make a pretty good case that it could go to 30,000 or something. And I hope it doesn't do that. But anyway, XOMO is killing it since ExxonMobil a bit. Absolutely. And that's why, and of course, for you guys that didn't see the top 10, here's the top 10. Same thing, Taiwan Semi is killing it. But yeah, of course, it's because, or TSMY is killing it. But, you know, all of these are up because of the parent. The option strategy, I mean, you know, I mean, some of them do have better strategies than others and have a little bit more upside or whatever. But I swear, 90% of the battle is picking the right horse. The option part, you know, contributes the extra 10%. But I mean, it almost wouldn't matter what strategy you did on TSMY, because the price has doubled in the past year or whatever, you know, or more than the past few months. Let's look at Let's look at TSM, and then we'll look at TSMY. Yeah, so I mean, TSM in the past 3 months has gone from 284 to 370. I mean, that's 30% or something. Well, yeah, there it is. I mean, that's amazing. And then TSMY gets 22% of that because you took part of the money off to pay yourself a yield. But so you aren't getting, of course, you aren't going to get the full upside because there's no free money. But yeah, so pick a stock that's going to go up, and it doesn't matter if you, however, if you pick a stock, but here's where the option strategy does matter. So let's say you like Tesla to go up. And let's say you're a big believer in Elon and Tesla's pulled back, but you also want some income. So you're going to consider income type Tesla plays. Well, if you're aggressive, maybe TSLY works for you. If you're ultra aggressive, maybe TSLW from Roundhill works with you because they use a little bit of leverage. If you're more on the conservative side, maybe you want TSLP. So it's not like the option, when I say the option strategy is irrelevant, not irrelevant. Any of those three is going to do great if Tesla's price doubles, though. But one of them might be better suited to, to your risk tolerances. So that's why it's great that we have so many to choose from. But really, it's just basically a bet on the underlying. I thought I had a Coke around here somewhere. I guess I don't. All right, you guys don't want to see any of these? Do you guys not want to see any? Look at this. I was amazed at how many yield max are in that. And I don't fix this, but I mean, you got St. Payne a 54% yield and the NAV's up 12%. I mean, yes, please. I'll take some of that. Look at the highest ranked kind of diversified, semi-diversified based on the market fund is DOGG. Now, yeah, it only paid 8% yield, granted, but the NAV's up 20%. You combine that with something like some of those other ones we're looking at that paid, that may have paid like 10% or 12% yield, but the NAV's only up 2%. Obviously, Dog's been a much better investment this past quarter because the momentum factors kicking in, and Dog's underlines. It's not really fair to compare Dog to a diversified fund like SPY-I. SPY-I is the whole index, or iSpy, whatever, where this one is just 10 stocks from it. But I was trying to show, I'm not trying to fix it. Where the Roundhill and Neos ones aren't in there. I mean, we do have one Neos one that just killed it, IWMI. I mean, so look at IWMI and RDTY, roughly the same thing. They're the same type of underlying, right? So, I mean, RDTY paid a 41% yield. Now, granted, it only had 4%, it only had 4% NAV return. So IWMI had twice the NAV return, right? So does it have half the yield? Not even close. So RDTY, definitely on a risk-adjusted basis, is doing better, and that's why it ranked higher. I didn't try to make it, it's just, but if the yield max funds rank high, they just rank high. In some cases, they actually do better, regardless of how much people think they suck. So it just depends. Different things for different markets. So, but yeah, it's really kind of surprising. There's 1, 2, 3, 4, 5, 6 yield max funds on the list this week. But I'll say this though. Also, yield max has 65 funds. So if I took and I may do this next week, if I took a percentage of total funds the company has out to, amount of funds they had on the list, probably I would say State Street would actually win, at least on the top 20, because State Street only has of the income funds, they have like 12 or 13 of them out. They have SPIN and they have all the sectors. I think there's 12 sectors and then SPIN. And, so they have 13 out. Well, of the 13 funds they have out right now, SPIN didn't make the list. But heck, they have XLII, XLBI, XLEI. And then in the second 20, they have, I'm sure they have more in the second 20. No, they actually don't have more in the second 20. But let's see which other State Street funds are on there. There's SPIN. SPIN is pays 8%. Has 6% now on NAV return. Not bad at all. Not bad at all, but there's just better options out there. XYLD, Devo. All right, the next State Street fund down is XLVI. That's healthcare. So, or the XLV is healthcare. So, NAV's gone up about 60 cents, which equates to 2.4%. Paid an 11% yield, very respectable. It's a 118 on stability. Well, that's a good fund if you want healthcare exposure. Anyway, that's the next highest State Street one. XLKI. That's tech, right? Let's look at XLKI. Okay, well, this one has not been doing great. So let's go back and look at on the factor. So that's why it's so low. That's why you had to scan through all these. And there's some XLUI, that's utilities. I thought those were doing better, and they were, but I think they sold off. Anyway, XLKI. So just look at it as far as an investment goes. Paying a 17% yield, but the NAV's just, I mean, the NAV's only up, less than a point. It was up 20 cents, which is less than 1% on $25. And it's not super stable. It's only a 68 on stability. Though we wouldn't expect it to be stable because it's based on tech. It's 2/3 as stable as the broader market. So yeah, there's lots of good choices tonight. Bondi. I thought this might be interesting also. I'm going to show you one more thing. If you guys don't have any questions, I'll let you go. You guys can go. But okay. Yes. All right. I wanted to show you this. So I gave these guys the data and I told them some stuff, some studies I wanted to see. But then they invented their own metric and they put it on a column after mine. They added it and they're calling it the top 5 highest efficiency. Anyway, and I just discovered they did it before I went on air or whatever. But anyway, they have they have IDEVO in there, and IDEVO didn't make the top 20, factor. It was like, what was it, 30 or something. But anyway, it's a good one. But they have IDEVO, GLDI, BNDI, DOGG, ASGI. So anyway, I didn't have time to mess with it, but I'm going to go ask them what the hell that metric is and kind of study it. But yeah, I just gave them the data, and then they came up with the highest efficiency funds, and they started writing about it. So, and then they made a white paper and kind of referenced it without me even saying anything to them. Let's look at this efficiency analysis. It sounds like something I come up with, and I think that's what they do. They're taking my lead and showing what I'm trying to show, but let me try to find this one where they came up with their own. All right. Yeah, highest efficiency funds, and I had nothing to do with this. So I mean, but I thought you guys might be interested. I mean, I agree with it. These are some great ETFs. I mean, GLDI is super volatile. I believe it uses a little bit of leverage, but let's go look at GLDI. I mean, but it's so let's see what it's called. It's called just gold shares. Okay. Down here, it's called something else. Flow STM 103. Oh, that's the index it's based on. I need to figure out what that index. Anyway, I'll do that on my own time. But anyway, so for what it's worth, I mean, maybe AI is getting, artificial general intelligence, because I was impressed they took my lead and tried to take it a step further. Like I said, I'll see how they did this or whatever. But anyway, yeah, IDEVO, I mean, NAV preservation for sure, 41% total return. Heck yeah. BNDI has the highest stable deck score. So, I guess that's why that one made the list. DOGG was on my list also. And then, of course, ASGI, the Aberdeen one, 49% total return with stability. I think what they've done is they look at the total return, and I don't look at that on the daily factor because I look at the components of the total return. I consider the NAV first and foremost, and I consider the yield separately because I'm studying the relationship between the two. When you put them together, you get the total return. So anyway, hey, Chad, what is up? Yeah, I know it. I mean, I said I agree. Chad's saying that Chippy is king. Absolutely. And I said in my live stream today that I like Chippy for no other reason because they have similar performance. They're 1 2. I mean, pick whichever one you want. But Chippy's based on more stocks, so that alone makes it better to me. Now let's see if that metric holds up. Let's go see if the daily factor can pick up on that too. In other words, Chippy on the daily factor stable dex is a 43. So if what I said is true, and if what I said is, I think I'm being intellectually honest, I think it's true and it's what I believe. But let's go see if over the past quarter the numbers have, borne it out. So Chippy's up 43. So, oh yeah, and there's TSMY right above it. TSMY is a 44. So no, that actually goes against what I said. Actually, over the past quarter, TSMY, if you're looking at the stock price and how much it moves up and down, it's about the same. But if anything, TSMY is a little bit more stable, but they're right there together. But yeah, just other things being equal, I think that I agree with you, Chippy. Here's the other thing. And if you have more money, so, if 4% will, or, if a smaller amount of yield will help you, 12%, then you have SOXY, which is basically the same investment. So let's see if that math holds true. So if that's true, if they're both really the same investment, one pays a massive yield and one pays 12%, the one that pays 12% ought to do a lot better on NAV return, not necessarily total return, but NAV return. So let's go look at SOXY and see where SOXY fell. Did I scan past it? Hang on here. Was it not in the second 20? Oh, yeah, there it is, 25. I did scan past it. Okay. So SOXY, hey, it's a 12% target fund, but right, it's averaging 9 lately, but or 9.5. But what's the NAV doing? The NAV's gone from 55 to 68. So that is 23% on NAV return. Now let's slide back over here. This one's NAV has gone from 15 to 69. It's up 12%. I'm sorry. It's up 15% on NAV. 15% on NAV is fine. And that's why Chippy's ranked ahead. Chippy's ranked ahead because is even after you consider that stuff that I was saying about SOXY, that if you needed less yield, that's true. But if you want to look at total return, the Chippy plan has been a better way to extract total return. And also at the same time, it's also extracted more yield. So yeah, Chippy's a special stock. I'll agree with you. But you know what I'm saying? The SOXY should be roughly the same. And if you need a less yield, SOXY might work in theory. All right. Chad is almost tempted to sell out of his WiMAX just to buy it again down here at the 8 strike. Yeah. Man, I'm sorry WiMAX has been so disappointing lately. I mean, yeah, I'm sorry about that. Solid hopes for the new stuff. Yeah, that Y10, the idea, the WiMAX would be a fine ETF right now if they had done a year ago what we were all begging for. Every time Jay's been on any show or Mike Coe's been on any show, at least once or twice, somebody says, when are you going to include the inverses in WiMAX? Or when are you going to include the portfolio funds? If they had put the inverses and portfolio funds in WiMAX, they would have got some of that winter and some of that, that and some of that Chippy. I mean, my gosh. Now, but there's other problems. That's not the only problem. But a lot of people think the problem is the equal weight, and that hopefully is getting fixed as well. So that's what I'm thinking. Yeah. So what are you talking AI bots? Did I miss on that one? Or no? Okay. Well, yeah. I don't want to do it with an AI bot, but what I do want to do is that here. Let's check it out. I have never even opened it up. Let's check out that Sylvia AI. I have wanted to try to do something with this. What is this Anthony Popolino? He's an influencer. Is this his deal? I mean, I've heard of this guy. What does he do? He's a professional capital management backed by Thiel Capital, or Thiel Capital, I guess. So, okay, well, I've heard of this guy before. Anyway, let me go back to the C. Maybe he's an investor in it or something. And is this free? Do I really understand this? I mean, I guess I need to sign up on this on my own time so I don't dox myself. But I could probably just hit Google and just put in my default. Anyway, you guys all know my name anyway. But yeah, I think this would be a good AI bot or something. Maybe I show Sylvia my factor or tell Sylvia what my goals are. I don't know. I'm gonna have to see how it works. Tell Sylvia that I want to build a high yield income portfolio that yields an average of 15%. That's kind of what I'm trying to do in real life. That's why I have some Alti, but then I also have some ones that pay like K Gold pays like 7, 8%. You know, ULTY pays. I'm hoping between when you average them all in, I have blocks paying 30, I have QLDY paying 28, you know, whatever. I'm hoping to average 15 or 20, which begs the question, why don't you just get triple QI and forget about it because they pay 15 or 20 already? It wouldn't be near as much fun that way though, right? Chad has all this money back from WiMAX. Yeah, WiMAX is actually, you know, depending on how long you had it, I was checking out WiMAX. It's definitely been disappointing. I'm not discounting that at all. But just falling off a ledge lately. But what I was looking at earlier is you're definitely, I mean, you're definitely ahead. I mean, you've got more dividends than the Nasdaq, but you aren't far from house money. I mean, if you've had it, you know, for a while, but it's been frustrating. It's the same thing happened to this that happened to all of these high yield funds. You can see it in WPay. You can see it in ULTY. You can see it in blocks. You could see it in K yield. What you could see is the SPY kept creeping up, and most of the high yield stuff, the fund to funds, the portfolio stuff like WPay, WiMAX, blocks, Alti, whatever, they have a lot of AI and crypto exposure. They have more than the equivalent in the index because they're trying to get a higher yield, so they have to take more chances, and they've all just fallen off a cliff lately. Like I say, I hate to see that. You know, that's since inception right there. That is since Alti's inception. That's not since WiMAX's inception. But if you look over the past quarter, so we'll do a little February. We'll look over the past quarter. Actually, look at ULTY just spanking the. I mean, they definitely did something to try to fix ULTY. Now, I mean, you know, we'll see. Jury's still out, but that is an improvement that it didn't, you know, just sell off like, you know. And then look at WPay. Let's look at WPay and Alti. You know, Alti's spanking it. So, but Alti's built, like I say, there's different funds for different markets. Alti has the puts, so they going to go down a little bit slower, but probably up a little bit slower. So, you know, anyway. All right, Chad says all the AI engines talk to each other and ask each other questions. Yeah, to come to an agreement. I got you on that. ChatGPT, Claude, Gemini, and Grok. Grok's too darn woke. I thought Elon was going to make it, you know, tell the truth. But I mean, you can ask Grok stuff, and it sounds like it was programmed by, you know, I'm just joking. But I mean, I'm just joking. All right. I really do think ChatGPT's too woke. I think Grok is good for when you want political type and searching the Twitter and that kind of conspiracy theory type stuff. Grok's fun, but when it comes down to getting down to business, I just think Claude's number one. And I don't like Gemini at all, as you guys know, but I do really like the other Google product, Notebook. Notebook is awesome, and you can even use Notebook and Claude together, which I have been lately. So hopefully the graphics and the presentation and stuff is getting better. Chat said, yeah, they're just paying my margin down. Yeah, I mean, at this point, you know, it's the same theory as if you go, let's say you work for whoever, let's say you work for, you're down there by Houston. Let's say you work for, I don't know, Kinder Morgan or whatever. But yeah, and let's say you have stock options. So what you do is you sell calls to make a little extra money on stock that you already own because you work for the company. But then if Kinder Morgan's stock goes into a dive, even though your calls are making money and you're going to keep making money off selling the calls, your portfolio is going to go down. It's no different than buying one of these ETFs. It's going to pay you the yield, but if you pick one that's on an underlying that goes down, you know the portfolio is going to lose money. But there's the good thing about these high yield funds are there's two ways to make money, because you can also sometimes, no guarantees, you can also sometimes stay around and collect enough dividends where even though your NAV's not great, you're actually, you know, on house money. Didn't Tesla just hit house money or something? Tesla's been around since 2022, so. But I mean, at one point, Tesla's underlying, Tesla was down like 80%. So, and it's impressive that to me that it recovered from that. Yeah, you can see, well, that's the past quarter. So obviously Tesla's doing better over the past quarter because it's been a down market. Generally, covered calls outperform on the way down, of course. But let's look since inception. Here's what I was talking about in Tesla. At one point, Tesla dropped early on into this fund. It dropped from being up 50% to down 25%. So that's, I mean, it went from 15, it dropped 50% there. That's, I mean, that's not good. Now you can see that Tesla actually protected capital pretty well and only dropped about 20%, but still that's when people started to figure out then people right in here were going, oh, Tesla sucks, erosion. Well, okay, maybe it sucks, whatever. But then as soon as the stock comes back, the ETF at least starts going the right direction again. But yeah, Tesla's not house money. What am I talking about? But it's only $14 away. So I've had some Alti shares for a long time, but I don't think I'm getting closer to house money. I looked at my I don't have much Alti anymore. I looked at my average cost the other day. I forget exactly what it was. So 66, 76, 86. Alti's $35 from being house money. So yeah, nowhere close, but nowhere close. What did you say, Chad? You meant to snap some photos. Oh yeah, the lily plant. They cleared land and put up the sign. So yeah, that's awesome. 6.5 billion dollar facility in Harris County's Generation Park near Lake Houston. So it's a manufacturing facility for API and next-gen small molecule medicines, obesity drugs. That's the growth business. 600 full-time jobs, 4,000 construction jobs. Well, check this out. If somebody had $2 million worth of Eli Lilly stock in 1979, how much do you think it'd be worth today? Not dividends reinvested, or it'll figure that by. So $2 million in the late 70s would be worth about $673 million today. But it's more than that actually, because they spun off 3 companies, and if you add in the 3 companies they spun off, the total on it. I did the same question the other day, and the total when you include the companies that got spun off and the current value of them is in the 900 millions. But yeah, growth stocks are a beautiful thing. You could, if you had Apple. Similar thing would happen. You don't even have to have 2 million. You could have, I mean, but yeah, growth stocks are a beautiful thing, and that has been a growth stock. Yeah, I know it. I know it. Anyway, snap some next time, but I'll send the pictures to my dad. My dad still has some Eli Lilly. He used to have a bunch of it, but he didn't want all his eggs in one basket, so he diversified. Anyway, probably a smart thing to do, but he would have been all right just holding on to it also. But you never know that in advance, right? So that's what makes it fun. If it was easy to make money, everyone would do it, right? You know, just think about that. If everyone can make money, then everyone would have a Lambo. There'd be no cheap cars, or not Lambos, but I'm saying the world would be full of sports cars and Range Rovers and whatever people like, you know. And then it wouldn't even be that big of a deal to have a Lambo or a Range Rover or something, you know. So nowadays it means you've either worked hard or maybe you had some Lilly stock back in a long time ago. Who knows? But yeah, that's not the only one. Apple has some amazing returns. Nvidia is going to be the same situation. There's people that that have Nvidia now, and their heirs, a generation from now will be billionaires, multi-billionaires. Well, I'm just thinking. I'm trying to think. Palantir possibly too. Yeah, Lambos would be taxis, exactly, kind of like they are right now. And I think in Dubai or something, they have like maybe not Lambo taxis, but they have fancier taxis and stuff, Mercedes taxis and stuff. Other parts of the world, they Mercedes aren't super fancy everywhere, but yeah, I bet you they probably have Maybach taxis over there in Dubai. All right, guys. Well, I'm getting tired. I'm going to get out of here. Let you guys go. I appreciate you guys sticking around. Thanks for watching the second 20. I hope you guys got something out of it. If your favorite fund's not in here, I promise I'm not trying to weight this towards the funds I like. Because really, I mean, if it was towards the funds I like, Blocks and Alti would be up here, right? I mean, I'm not trying to put my thumb on the scale. I mean, the math is what the math is. Blocks is nowhere close. I like K-Yield. It's nowhere close. I like QLDY. It's nowhere close. QLDY is probably closer than the other ones, but in any event, I mean, the math is what the math is, and the best risk-adjusted reward lately, I mean, it is what it is. These are the companies that have been compounding money. These are the high yield ETFs that have been compounding money at the fastest rate with the best, especially when you consider the risk that you're taking, right? All right, guys. Well, like I say, thanks so much for watching. And next week, a couple of announcements. We're going to do if you're in my Discord, we're going to start doing a family Discord meeting, a MaxFam Discord meeting, 7 o'clock my time, 7 o'clock Central, 8 o'clock your time if you're on the East Coast, Sunday nights. We're going to meet in there for about an hour. There was only 2 of us tonight. It was me and Brad. And we had a great talk, but we're going to plan it better. And next time it can be maybe 5 of us or 10 of us. We kind of like what Kamir does, I don't think I'm going to broadcast it. We'll just get in there and shoot the breeze. But then as soon as that's done, I'm going to do like I did tonight and have the regular Daily Factor show. So if you aren't in my Discord, I'm not really publishing invites. Everyone's in my Discord. If you aren't in my Discord and you want to be in my Discord, shoot me an email. maxconvexity@gmail.com, and shoot me an email, and I'll shoot it to Marcus and have him get you in. I don't even know how to get people in. Marcus and all those guys handle it. You have to go something, and then they have to talk to you and make sure you're a real person or something. But anyway, if you want to get in there, shoot me an email. Now remember, this is not financial advice. Consult a professional advisor who knows you and your personal situation. If you'd like to support the station, you can always do so at paypal.me/maxconvexity. It goes to pay my AI bills. And other than that, you can also hit like and subscribe. And I always appreciate that as well. And I will talk to you guys tomorrow. Have a nice evening.